Hey, what's up, stock compounders? Brad here. So today I want to give my highlights of a Q&A done recently with Bill Ackman. Okay, this was a Q&A on August 24th, 2020, so just a couple weeks ago. It's an hour and 7 minutes. I'll link to the video in the description, but I wanted to share my highlights. So Bill was asked, when did you start to get really concerned about the pandemic? Because we all know Bill Ackman made a big bet in March of 2020 that the markets would get much more fearful than they were as this virus spread. And really, when Bill Ackman started to get concerned, it was January. The Chinese announced a shutdown of Wuhan, right? They gave a 12-hour notice that there was going to be a lockdown. And 5 million people left Wuhan within that 12 hours. Now, of course, Bill Ackman he understands compounding very well. So when you have a region in China where there's a virus spreading very rapidly, and then you have 5 million people that disperse from that area, it's not that difficult to do the math in your head when you have a virus, number of cases doubling every day, every couple of days. Sure, it starts small, right? But it grows very large very quickly. And from that point, he started to see, all right, this thing is going to spread far and wide. And so in March, he was considering selling out of his stock holdings, right? He actually sold some of Starbucks, and he was considering selling other positions, but then he thought to himself, well, instead of unwinding these equity positions, what if we just hedge? And so he came up with this idea to buy credit default swaps because he understood that the credit spreads are highly correlated with how much fear there is in the markets. So, he made almost 100 times the initial bet on those credit default swaps. I think it was like 2.7 billion that Pershing Square made from that bet. So it was a great position. And then, of course, the proceeds from that, he was able to put into great long-term companies that Pershing Square is invested in, like Lowe's, like Restaurant Brands International, companies where the prices had been quite depressed, maybe 30 or 50% down from the highs in 2020. So it was just, not only was it one of the best trades of all time, but it happened at such an opportune moment where all of those proceeds could be put back into businesses that he loved at bargain prices. So just a really remarkable story there. So Ackman was asked, are the markets completely disconnected from the economy? And he doesn't think that the markets are entirely wrong here in terms of how the markets are valuing businesses. The dominant players, you think of the FANG stocks, maybe plus Microsoft. The dominant players have the capital to survive. They have the resiliency to survive what's happening. And in fact, these large and dominant companies have become larger and more dominant as a result of the pandemic. Because, smaller businesses, all of these, big companies like Lowe's, like Amazon, not really Facebook and Google, but big companies who really dominate their industry, they're oftentimes competing against a lot of small players. And in aggregate, those small players add up to something. The issue is the smaller players. It's really hard for them to innovate quickly in times like this, like where larger companies might be able to, offer a delivery option instead of people having to come to the store, or like with food, for example. You're more agile if you have a lot of capital, and if you have a franchise where you can quickly give feedback to other franchises on what's working and what's not in terms of pivoting to the current situation. Whereas the lone mom and pop operation, they don't have that advantage. So that's one reason the large and dominant companies are becoming even larger and more dominant throughout this pandemic. So it's not that everyone is doing well in the markets. It's that the larger players are really carrying the markets. That's kind of what we're seeing. There's more of a separation between the large dominant and the smaller companies. He was asked about the U.S. balance sheet, with all this printing of money, all this debt creation to help the people who need help to move through this pandemic, whether it's unemployment payments or stimulus checks, all that stuff. The balance sheet is, so Ackman made this cheeky comment, the U.S. balance sheet is beginning to look like an appealing activist investor target. If you look at the U.S. as a business, it's getting a little scary in terms of the amount of debt that the U.S. has taken on. Of course, we still have a ton of assets, right? The U.S. is an incredibly rich company, and one of the strongest assets of the U.S. is the ability of the government to change taxation rates, in a very short period of time. That's perhaps the largest asset of the U.S. government, is the ability to determine whatever taxation rate they want, both for individuals and for corporations. So, that deserves a lot of respect. That ability to do that. That asset on the balance sheet is immense. He was asked about bonds in this environment. He says equities. Bill Ackman says equities are a vastly superior alternative to fixed income in this environment, where you've got negative interest rates. There's a lot of issues of negative interest rates, and so really a stock certificate, when you take an equity position in a company, it's a variable income bond. There's no fixed amount printed on the coupon. It's up to us as investors to figure out what is that coupon. So it's a variable income bond, and it doesn't have a terminal value. Okay, there's no date where the company says, okay, this is when we're going to return all of your money. Really, with stocks, with equities, the current coupons, it's easy to find 5% coupons, 5% interest. And of course, they can grow. They're not fixed from year to year. So, it's very difficult to make a case for bonds in this environment. Bill Ackman says, stay far away from fixed income instruments in our current economic environment. And it got me thinking, I've been thinking a lot about Ray Dalio. He's been buying a lot of gold lately, and I've been thinking about his all-weather portfolio and how more than half of the all-weather portfolio is bonds, right? And so it got me thinking, I'm very curious, how Ray Dalio would kind of put together an all-weather portfolio at this time, based on this time in the market cycle, where Dalio thinks we're nearing the end of, what does he say, the long-term debt cycle in the U.S. is coming to an end. So that got me thinking, if any of you know what Ray Dalio would say, or maybe he's talked about it in terms of what an all-weather portfolio would look like in this environment. It even sounds funny to say, because in the name itself, it's a portfolio that's designed to do well in all conditions, all weather. But it's an unusual situation. So I'm just curious if he might have some alterations to it based on how low the interest rates are right now and how long those bond payouts are. Okay, so this next part, Bill Ackman talks about how his investment philosophy has changed in the 20 to 30 years that he's been managing money. In the beginning, when he got into the business, he was very focused on price and value. Well, that sounds familiar. Sounds a lot like Warren Buffett. Buffett wanted to find cheap businesses. Okay, they didn't have to be great businesses. He was looking for cheap businesses. So businesses where the price, what he could pay for them, was much lower than the value, what they were actually worth. So that's what Bill was focused on in the beginning. No surprise there. Bill Ackman is a strong Warren Buffett disciple. So his philosophy has really changed with Warren Buffett's. Whereas today he's very focused on quality, durability, and growth. The question that really keeps him up at night is, can two students in a Stanford dorm room come up with a business model that could disrupt this business, right? That's the question he always asks himself. How disruptable, as we advance technologically, is this business? Can it defend its moat against technological disruption? And then he was asked about management. Like, how much does management factor into, how interested you are in buying a business? And, it doesn't factor in that much. And here's why. Because the companies that Bill Ackman really likes tend to be great businesses with poor management that are available at a price that's interesting to Bill Ackman. And the reason that they're available at a price that's interesting to Bill Ackman is because they don't have great management. And one of the things Bill Ackman and his team are very competent at doing is finding the right management to take the company forward. Bill Ackman bought Chipotle a while back, and the founder of Chipotle was a visionary, very competent at launching Chipotle, getting it off to a great start. But the founder of Chipotle was not great at growing the business, right? He was great at getting it to the stage it was, but didn't have the skills really to take it further. And so Bill Ackman and his team helped find management that could do that next phase, that can really execute that next phase of the business for Chipotle. And usually when you have a situation where you have a great business and great management already in place, it's very difficult to get a compelling price, to buy those businesses at a compelling price that a value investor like Bill Ackman would be interested in. So that's really the kinds of businesses that he's targeting. He also mentioned a quote by Warren Buffett where, when you have a business that has a reputation for mediocrity and a management that has a great reputation, it's the reputation of the business that's going to remain intact. And so it's really important to focus on, is this a great business? Because if it's not a great business, it's going to be hard to find any management team that's going to make that investment perform really well. But if you start with a great business and you can you know, trade out the management, then you've got a potentially winning combination there. So, you know, that's just highlights from Bill Ackman's interview on August 24th, 2020. Again, I will link to that in the description. You know, every time I watch Bill Ackman, I just get so many gems. I really appreciate how candid he is about what's happening with Pershing Square, and I'm really appreciating him more and more as a mentor, as someone to look to make myself a better investor. So, you know, if you have an hour, check out his video and let me know what your highlights were from the video. I'm curious what's resonating with you guys. So leave a comment, let me know, and I will see you guys in the next video. Take care.